Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Covered Calls and Short Puts. And today we're talking about making the decision to hold on to a covered call position or roll to another expiration or another strike. I think this is going to be an interesting discussion because there can be a time when a trader can struggle to know whether do we hang on to the current position, continue to collect that premium, or maybe go out, try to get a bigger premium. What are the pros and the cons of those involved in those decisions? We have several examples in our paperMoney portfolio that are going to help us explore that. But before we can get to those, let me first of all say hello to everybody who's chatting in. Great to see all the familiar names out there in YouTube. Welcome to anybody here for the very first time. But hello there, Greg, Lawrence, Ryan, Eva, Scott, Mark, Simone, Kevin, Life in the Fast Lane, Wiley, everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you are among those that are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts. But you're certainly invited to be here in the live stream audience if you'd like to be here. This is a Monday webcast series, and we kick things off promptly at 2 Eastern time. Now, I also want to let my live stream audience members know that my very good friend Barb Armstrong's hanging out in the chats. Barb's going to be addressing any questions that I can't get to just during the flow of the presentation. So thanks for having my back there, Barb. Barb and I would also like to issue an invitation to everybody listening to follow us on social media. You can find Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X at Cameron May CS. We're both very active there. Now you can also follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. But let's get into this discussion. And of course, as we do, covered calls and short puts, like other strategies for trading or investing, involve risk. So we need to bear in mind this very important risk information. Options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as the sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today. Now, typically each week we start off with a review of our current positions. And I think it's that review that's going to give us the opportunity to have this discussion that I think can be very important for income-seeking options traders. And that is, when and how does the trader make the decision to roll from a current covered call into a subsequent covered call? Today, we're going to be looking at that through the lens of a covered call that has shrunk in premium. So these are out of the money positions. When do we think enough is enough? Time to wrap that one up, maybe sell another premium. What are the pros and cons of that decision? So as we do our portfolio review, we're going to be walking through 3 covered calls where that is the scenario. The call has gone significantly out of the money. We're getting pretty close to expiration. Let's weigh the pros and cons of rolling. Now, as we do that, we're also going to take a look at what's going on with current market conditions for stock investors and options traders. And time permitting, we may be adding a new covered call to our existing portfolio. All right, but that's going to be the agenda for today. So let's go right to the thinkorswim desktop platform. This is the paperMoney software, and we have 6 positions. So here's what we're going to do. We're going to look at Apple. Then we're going to skip down here to J&J, Nvidia, and then finally we're going to wrap it up with Walmart, AbbVie, and Amazon. So let's start up here with Apple. This is a covered call. We sold a call for the 17th of April. For $2.68. Right now, that's priced at about $1. And we need to look at the entire history of Apple. So let's go, because right now we can see on just the shares and this current covered call, or this current call that we've sold, down 1,100. But if we take the full history of Apple into consideration, it's actually been a decent trade so far, despite a pullback in stock price. Okay, so here's that history. We originally sold some puts, sold 2 December 19th, sold 2 December 19th, 265 puts. Those expired for $277 on each contract as a profit. Then we sold some more puts. We actually sold 1 put for the 16th of January, 265. That was assigned. So we're starting to accrue some premiums here along the way, but we did get assigned the shares at 265. So that's what we paid for 100 shares of Apple. Now, since then, we've sold a 20th of February call. That expired for a 220 profit. We sold a 20th of March 280 call. That one we just closed last week for a 229 profit. And then we rolled that into a 17th of April 275 call for 268. Now, that was right here last week. The stock went up a bit. We pulled back over this last week. We're still above our break-even point. And I think we're going to take a closer look at this. If we happen to break through recent price floors, we may consider wrapping up this trade at that point. But overall, this is just a little bit above break-even trade. All right, so now let's go to our next position. We're going to let that one continue to work. There's still a fair amount of premium remaining in that contract we sold, over $1. But let's skip now down to Johnson & Johnson. This was last week's short put that we sold. Sold that for $1.89. Interestingly, that put has already shrunk to about 60 cents, about 65, approaching 70% of the original credit is already an unrealized gain on this one. So that trade's doing just fine. Here's that on our chart. If we look at this on at Johnson & Johnson on our chart, we see that we sold that 20th of March 235 put. I always draw in a line just to represent when we started the trade and when that expires. And you can see the stock has been fairly cooperative, working its way higher. And selling a put is a bullish position. So that's been working its way further out of the money, which is good. Our break-even's down here at 233.11. I think we're going to let that one continue to work. Next up, we have our Nvidia position, another covered call. We own the shares at 183 and change. They're worth 184 and change. Basically break even on the call. On the stock. Basically break even on the option. Just up a bit on that one. But let's look at the entire history for Nvidia. This one actually has been, you can see we bought the shares back here. You can see where those shares are trading right now. So the shares have returned little value. It's actually the contracts that have really been delivering for us. So this all started way back here. We sold a December 195 call, closed that for a 343 profit, sold in November. Actually, so we started with November. Sold the November call. That one expired for a profit. December expired for a profit. January expired for a profit. February expired for a profit. March closed that for a profit, for a 740 profit. And that one actually is a pretty quick turnaround. And finally, we're into April, which we've sold for 420. That's still trading around 420. So overall, this has been a nice series of trades. And we do have a plan that if we break support, we might choose to exit. And that support has just been holding. So our break even has actually been lowered all the way down here to 159.59, including this 1 cent. Did we get another one? Yeah, so it's actually 159.58. We get little tiny dividends on this stock position. So not much of a consideration there, but overall that trade's doing just fine. I'm not going to be doing anything with that today. But let's look at Walmart, and this is going to take us to our discussion of making that decision for when to roll. Now, if we don't know what rolling means, rolling is a fancy term that we use that just means using one order ticket to close out one trade and to get into a similar, potentially related trade. That's it. Closing out one, getting to another on the same order ticket. In the case of a covered call, what we'd be doing here is buying back a call that we previously sold and then maybe selling a new call either at a different strike, maybe just lowering the strike to try to get a larger premium, maybe going further out in time at the same strike, or possibly going further out in time and choosing a different strike. So lots of different ways that a rolling order might be accomplished. But I wanted to look at this Walmart position, and let's look at its entire history. So here's Walmart. Shorter history. With this one, we bought 100 shares at 104.25. Those shares have treated us well. And just relatively recently, right here, sold the 20th of March 132 call for 143. And that's been pulling back. It's also been working its way toward expiration. So this 143 that was collected, how much would it cost us to buy out of that right now? It looks like it would be about 10 cents. All right. Now, for some, you might look at this and say, Cameron, that's a no-brainer. We should be closing this out. I got to make the case that there are pros and cons to each decision that a trader makes, right? And that is certainly the case here as well. Now, sometimes the pros can more decisively outweigh the cons, but we still need to weigh both sides in order to be making an informed decision here. So let's just say that our would-be covered call trader here seeking income recognizes that, boy, it sure seems like we've gotten just about all the income out of this contract that we can. It's true, just about all, but not all of it. Mark says, I'm in the no-brainer camp with that one. Yeah. Zinc 56 says, where's KMI? Is that from another class? It would have been Zinc. Yeah, we don't have a KMI position in this webcast series. Yep. But here's the situation with this covered call. There's only 10 cents left to be made in this position. $10. That's 100 shares, 10 cents a share. That's $10 that can be made. So we might just say, well, let's just roll. And that may be the conclusion that our income investor might come to. But let's also be realistic about that $10. What would be an argument for? Let's make an argument for holding first, and then we'll make an argument for rolling. And let's do that with each of these positions. All right, what would be the argument for holding on to the position just as it is? Don't roll. Number one is there's a very low probability of assignment on this. So if our trader really prefers not to have to sell the shares, well, the call is up here at 132. Someone has the right to buy shares from us for 132 bucks. Those shares are only worth about 125. There is a low probability, still possible. It's just pretty improbable that that trader will decide to buy those shares from us. All right. So if assignment risk is a concern, it's not much of a concern when we're this far out of the money and we're this close to expiration. Now, another argument that might be made for holding is that even though 10 cents doesn't feel like a lot, that these last few days can be the highest earning days of the entire contract cycle. That's not going to be the case every time, because there are going to be times, kind of like this one. Actually, this is a decent example where if the stock goes fairly sharply downward, this one didn't go terribly sharply downward, but if we go sharply downward, actually that income, we can have that unrealized gain pretty quickly because we're getting a combination of time decay and price moving in the favor of the trade. So we've kind of gotten a combination of both of those. However, the trader should probably be realistic with themselves. If there's a substantial amount of premium there and only a few days left till expiration, those can be some of the highest earning days of the entire contract cycle. That's what I'll say. On a day-to-day basis, this may be the best income, where the covered call might be kind of in overtime mode. Now, that's not really the case here. Bottom line, it's only $10 that can be made if we stick with this position. But also, we just don't want to ignore the fact that that there's just a few days till expiration. So if we just hang on to this, that final $10 can be achieved relatively quickly, and that's the most likely outcome. Mark's saying, you've already got more than 90% of the value in this one. It's not worth the risk of holding out for the rest. Well, what is the risk there, Mark? There is a risk, yeah. Well, rolling isn't the only decision that this trader might make. Maybe they look at this and say, you know what, we actually bought the stock down here at 104. It's worth 125 right now. We could just sell the stock right now. No more risk going forward. No more market risk on the stock ownership. But if they decide to hold those shares in pursuit of that $10, remember it's basically 10 cents per share. It's a pretty small amount. Could the stock go down more than 10 cents in the next 4 days? There's certainly that risk. Could it go down substantially more than 10 cents? Yeah, so if the decision is sell the stock close the contract and just be done with the trade, or hold the stock so that we can see if we can make the remaining 10 cents. That's a pretty high risk to reward scenario there. All right. But what about rolling? What are some considerations there? Here's what I mean by rolling. Again, we're using terminology not everybody's familiar with. Like I mentioned earlier, rolling just means getting out of one position, then getting into another similar or related position. So here's what let's look at maybe a proposal here. And I haven't looked at the numbers on this to see if it makes any sense. But let's say that our trader is okay with maybe the share price being capped for them at 132. I wonder how much we might get if we were to roll this position from February out to from March out to April. Let's just keep the 132 level up at those previous highs. So we're still agreeing to sell the shares to someone else for 132. It's just we're extending that agreement out to April. Let's go see how much we might be able to get for that premium. Let's go to the 17th of April, make sure we're looking at Walmart. You know what? It's not even available. That's why we look. We might have to consider different strikes here, and different strikes are part of the consideration process when making this plan. So let's do this. Let me activate this drawing, and I'm just going to drag it down here to 130. There we go. What if our trader is looking at continuing with the obligation to sell the shares for 132 for the next 4 days, and maybe they get 10 cents out of that, or they enter into a new obligation where they might have to sell the shares for just $130. So we're agreeing to sell the shares for a lower price. What would be the argument for that? Well, it's going to bring in a higher premium. We got 10 cents to make here. How much might we make at the new strike price, the 17th of April, 130 strike? That looks like that's between 205 and 216. That's going from $10 of income potential over 4 days to over $200 of income potential for over the next 32 days. So here's the argument. A bigger premium lowers the break-even point of the trade. Because if we have a new premium that's been collected, we can add that to previous premiums, add that to our dividends, lower that break-even point by probably a couple of bucks here. So we get a lower break-even point, get a higher premium, and there's some flexibility in this decision. Does it have to be the 17th of March? We could choose some other expiration. This contract actually has weekly contracts, or this stock has weekly contracts. We could go to, instead of the 17th of April, maybe the 10th of April for 25 days, or the 2nd of April for 17 days. Maybe we could choose a different strike price. What if we went to the 17th of April, and instead of selling the 130 call, we go for the 135? That would actually give us more wiggle room to the upside. Our cap on our shares would actually be up here at 135. The trade-off there would be a smaller premium, going from over $2 to under $1. Yeah, Mark's saying you could sell 10th of April 132s for around $1. Let's look at that, Mark. Let's look at the 10th of April. And it does have those $1 increments for those weekly contracts. The monthlies don't have those, at least not for April. Yeah, we could look at the 132. It looks like that's trading for between 104 and 119. Maybe get $1.10 out of that. That would be 11 times the premium that we have for the March expiration. But it's even just the same strike price, same obligation, just more time. All right. So which one is the right one? Which one is the correct choice for our trader here? It's down to that trader. If they're willing to sell the stock at a lower price, they can get double the premium, basically. If they prefer to sell the stock up there at 132 and maybe take on a shorter term obligation, they could go with what Mark has proposed here, the 132 for the 10th of April. And maybe we can get around $1.10 for that, maybe a little bit more. I think let's do this one. Let's just keep it right at the same strike. Let me edit the properties of this line. So we're starting this today. So today's the 16th. And we're going to take this out to the 10th of April. And we're going for the 132 strike. Let me make that red. What this is going to do is just represent, there's our new expiration right there. It's going to go right out here to the 10th of April. So this just gives us a visual reference point for where that cap is on price. You know, the obligation we have here is to sell at 132 and how far out it extends. And this might take us from 10 cents of income up to $1.10. Let's see. Let's see if we can roll this. So let's go place this rolling order. Let's go to Walmart. I'm going to right click on the strike price that we're in right now. Right click on that and create a rolling order. This is going to describe this as a calendar. Calendar is just it's a strategy where a trader is both buying and selling contracts at the same time. That's really what this is. Except in this case, we're buying to exit the contract that we're already in. That's our 132 for the 20th of March. And then we're selling to enter into a new covered call. And we're going to stick with 132, but we're going to push that out to the 10th of April. And it looks like well, actually, no, that's about right. If we're buying this contract back for 10 cents and we sell this one for about $1 or $1.10, that would give us a net credit of around $1. How about we say, let's see if we can get that. You know what? Just in the interest of time, I'm going to dial this down and say that we're willing to settle for 95 cents to roll this. So if, let's say we pay 10 cents to get out of the first contract, receive $1.05 to get into the next one, that would be a 95-cent net credit. In any case, let's click confirm and send. And we're going to sell this, which is being described as a calendar, but basically this is to buy the 20th of March contract and then sell the 10th of April for hopefully a $95 credit. That's just what we're going to enter as our hypothetical minimum credit here. There is a commission to be paid to close the one out and another commission to be paid to open the new one. So that chips away at that bottom line credit, but let's send that off and see if we can get that filled. All right, so there's Walmart. I don't think it's going to take us quite as long to talk through AbbVie because this is going to be very, very similar. All right, let's see what our working order is doing. All right, so we're only asking for a 95-cent credit and it looked like it was at 102 and it filled at 101. Yep. So we're done. We can actually see our filled order right here. Closed for 10 cents, rolled out to the 10th of April for $1.11. All right, so let's look at AbbVie. Here we have 200 shares, and we've sold 2 contracts that we're in right now. We sold those for $1.65. There's only 6 cents left. Even on 200 shares, that's literally $12. Now, there are only 4 days left on those contracts, and there's a very high probability that if we just leave things alone, we're going to make another 12 bucks on that income. But let's look at AbbVie. Let's see what's going on with its chart. Let's weigh the pros and cons. Sounds like there are a couple of amens out there. I don't think it was referring to this. Oh, I think, yeah, just a little side chat, unrelated. That's totally fine. But in any case, here's the history of this covered call. Bought 200 shares for $227.18, sold some 2nd of January calls. Those expired for $1.83 profit. Then we sold 2nd of January 240 calls for $1.93 profit. And most recently, actually reverse that. Is that right? Yeah. We just got a quick drop right there. That's what happened. Or drop, nope, right here. Anyway, most recently we've sold into these 2 20th of March 240 calls for $1.65, and it looks like those are worth 6 cents right now. So we may be able to close those out. What would be the argument for retaining those contracts? Well, there's still 6 cents to be made. Times $100 or 100 shares would be $6. Times 200 shares, that's our $12. That $12 has a very, very high probability of being realized if we just leave this alone. Now, another thing that we might consider is if we don't roll, if we just let these go to expiration, we also save any commissions that might be charged to close the current contracts out. If that just expires worthless, and that looks like a very high probability scenario. But still, our income investor might say, you know what, 12 bucks, I think I can do better. Even on a daily basis, that's getting down to not being very much money. It's literally pocket change. Yeah, even you say side chat on that, it was going back and forth. Yeah, very good. Anyway, we're just above the break-even point on this net position, which is fine. But let's say that our trader is just now making a decision. Should I roll? If I decide to roll, is today the day to do that? Or maybe should I just exit? We always have to remember that. We already have a plan for exiting this. And that is, we're going to consider exiting if this support breaks right down here, right around 210. As a matter of fact, I should bring you up to speed. I forget this. This was something that I decided to discuss with my audience when I kicked off the webcast. So this is a new drawing. If you didn't see that last week, I put that in here. But I just wanted to roll this out as a possibility for the management of this position going forward. It looks like a previous resistance right around 210 has been acting as a pretty solid support now since we entered this position. So let's just say that our trader who's managing this stock, as long as we're above 210, we're just going to hold on to that. All right. So in any case, now the question just is, do we hold out for the 12 bucks or do we look to see what we can roll for? And I wonder, so we're currently in a 240 strike. I would suspect we're not going to get much premium for that, even if we go out to April. That's quite a ways out of the money. It's nearly $20 out of the money at this point. Let's go take a peek anyway. Just stick with the same strike. And you know what, actually for April, between $1.60 and $1.80. So it's not quite 1% for a 32-day contract, but not every trader requires, you know, some minimum amount like 1%. But let's weigh the pros and the cons. So what are your initial impressions as you look at this 240 strike? Let's make an argument for that. First of all, it's way out of the money. It seems like there's quite a low probability of assignment. If we were assigned, we would be selling the shares for $13 more than we paid for those shares. So we might still be okay with selling the 240. But maybe we ought to do a lower strike. Agree to sell the shares at a lower price. That may still be not terribly likely. What if we looked at maybe the 235? That's going to be right around here. There's 235. I'm kind of positioning that right over today's candle so we can see the length of the obligation of the contract. There we go. So we're putting a lower cap on how high our shares can rise before someone can buy those shares. You know, this is just theoretically a cap on how much profit potential we have on the share ownership. But the trade-off is we're likely to get, we would get a higher premium if that strike were available. Not available for the monthlies. Let's look at those weeklies again. Yep, it's available for the weeklies. So looks like those weeklies we might be able to get, and it's probably going to be more than $2. So instead of being a little less than 2 for a 32-day obligation, it's going to be a little bit more than 2 for a 25-day obligation, but we're also agreeing to sell the shares at $5 lower strike price. What do we think? Yeah, Mark says you're going to have to go for weeklies if you want to go to that 235. In this case, I think I'm going to maybe go up here to 240. But again, let's just recap the argument for just sticking with the position. Theoretically, potentially a higher per day income. With 6 cents left, maybe not. There's a low probability of assignment if we do stick with the current price. We're avoiding potential commission on closing that out. There's just fewer days left on that obligation. All those can be arguments for. Arguments for rolling. And again, let's actually just do this. I'm going to right click on this and let's just remove that drawing and just draw in a new one. Right up there at 240. There we go. What's the argument for this one? Higher premium lower break-even point, because our break-even right now is at 220. We're going to be lowering that by nearly $2. So that could bring it down to around 218-ish. And we've already seen some of the flexibility in how we can choose which strike price, which expiration. I think with this one, D. Ken says, how's X dividend going to factor in? That's a really good question there. That could be, and this was also a consideration for our last example. If we were to go back to Walmart, there was a dividend that was coming up, and this might influence. Oh no, yeah, it's coming up right before the expiration. That might influence the decision to hold on to the shares. So if a trader was considering just selling, well, this could help out a little bit. The premium was only 10 cents, but there is about 25 cents of dividend that could potentially be collected. But this is a big deal. Is it really an advantage to hold on and collect that dividend? What do we have to remember when a dividend is paid? Oh, good, we got 25 cents that's deposited to the account, but the share value is adjusted downward by 25 cents. So that's kind of a wash. Now, as we go back to AbbVie and we look at that dividend, that doesn't mean that someone else might not see it that way. Having a dividend that's paid, especially as we're getting right close to expiration, some traders will say, you know what, Cameron, I bought that covered call from you. I'm going to assign that option because I want to buy the stock and get the dividend. That can sometimes happen. A dividend can somewhat slightly increase the likelihood of early assignment, especially if there's not much time value left in the contract that the owner of the contract might be surrendering. So the dividend, it's not a non-event. It can influence decision making, but also remember that collecting a dividend is nice, but price is also adjusted by the dividend amount. So theoretically, it's sort of a non-event for the shareholder, theoretically. Okay. All right. So let's do this one. Let's roll this 6 cent. Is it still 6 cents? Probably something like that. Let's roll that out to the 240 for the 17th of April. So here's how we might do that. Let's go to AbbVie. I'm going to right click on the strikes that we've sold. Let's create a rolling order. And again, it says selling a calendar, but this is to buy back the 2 contracts for the 20th of March. Selling 2 contracts. We're going to stick with the 240 strike, but we're going to push that out to the 17th of April. And it looks like we might be able to do that for about $1.64, maybe $1.60. Let's say we're willing to settle for $1.60 credit. That would be, an example might be paying 6 cents to close out the current contract and collecting $1.66 on the new contract would net us $1.60 credit. But let's just enter that as our limit. Click confirm and send, and we're going to close out. We're going to look to close out these positions. Okay, or close out the 20th of March, roll it out 17th of April. If we do, there are commissions to be paid on the 2 contracts that we're closing. On the 2 contracts we're opening, total commission of $260, bringing the net minimum acceptable credit for this roll to $317.40. Let's send that off and see if we can get it. So it was quick. Yeah, sold that, rolled it for $1.64. So that's AbbVie. Now, there's one other. These 2, I think, for a number of you probably looked at the Walmart and said, yeah, let's do that. 10 cents left to be made. A number of you probably looked at AbbVie and said there's 6 cents per share on those contracts. Yes, let's do it. What about Amazon? This one could be a little bit trickier. So here's Amazon. We own 100 shares. We've sold the 20th of March 220 call. The shares are at 235. Let me bring this up on our chart. There we go. All right, so wait, it says we sold 100 shares here. What am I doing here? Oh yeah, it's 100 shares. Yeah, that's right. Okay. Yep, we did close out 100 shares on this. Anyway, the entire history of this was it started with selling 2 puts. for 370. Those were closed. Closed one of those puts for a 303 profit, closed a second put for 365. So there's a $668 profit that was already realized on those two puts. Then we sold some more puts for 560. We kept those premiums, but those contracts were assigned. So we bought the shares at 235. That's up here. So where are those shares right now? Well, they took a big header on a poor earnings announcement, and they've kind of been in recovery mode since then. After the earnings, though, we closed out two of those shares on this break of support, with the plan to hold on. If the next level of support broke, we were going to close out the remaining shares. Those shares have been in recovery mode. They've been going up, didn't break that support. So in the meantime, we sold a call on those shares for $2.09. Now, that call is now worth, what was it, about 42 cents? About 42 cents. That's not 6 cents. It's not 10 cents. And we're up here at the 220 strike with the stock down here at 211. So $9 out of the money. $9 out of the money. $42 to make, with a high probability that this is not going to be assigned. Yeah, this isn't quite as straightforward. So what are the arguments for retaining ownership of these shares? This one, I think, is a good example of how those last several days can be the highest return days on a daily basis. This is a big chunk of the potential income earnings. This is an out-of-the-money contract, doesn't need to do anything. We just need time to go by, and we could make now $45 on this contract. However, there are still some that might say, yeah, but we've made most of our money here, and maybe what I could do here is roll that contract up, maybe up to 225, maybe up to 230, push it out till April. Reduce assignment risk, because if we got a rally here, even now the money contract can be assigned, but if it's in the money, if we're above 220 at expiration, that's where assignment moves from a probability to a near certainty. We get above 220. Mark's saying this Amazon call has worked out well for you. It has so far, and if the trader's okay with selling at 220, we might just decide to hang on to this. But our break-even's up here at 224. I wonder, could we maybe get a 225 in play here? So even if we get called out, we'd be selling above break-even. We'd be lowering the break-even even further if we were to roll this out. There are pros and cons, but I think this one's a little bit less straightforward because there is a fairly notable amount of money left here. This covered call, when we started it, only had $209 that it could make, and there's still $45 that could be made, and a high probability that it'll just be made if we just leave it alone, let that continue to work. I think with this one, we're just going to let it go, but I think a case might be made. Let's say that our trader would prefer to move their strike above their break-even point. That almost certainly could be done if we move this out to April. Let's see. Wonder how much of a credit we might be able to get if we were to go out to April. Let's go to the 17th of April and look at the 225 strike. What's that selling for? Yeah, 263 to 268. It might cost us 45 cents to buy out of the contract that we're in. Let's say we're able to sell the new one for 265. That would actually bring in a credit of 220. It would lower the break even down to like 218. And if we're called out, we'd be selling our shares for 225. That would be above break even. So that's a possibility. I think what we're going to do here, though, we're going to let this one work. For better or for worse, we'll know next week whether this turned out to be the right idea or not. I'm going to let this one go to expiration, and next week we'll see whether it got assigned or not. Now, one of the luxuries that we have in paper money is that early assignment is not a thing. Early assignment doesn't happen in paper. In real life, it certainly can happen, and especially as we get closer to expiration, and particularly if a contract goes in the money, that raises that risk of early assignment. But we're going to let this one continue to work. Let's see, Barbara says, is technical analysis part of your decision? AbbVie sitting at some support that it could bounce off of. For some traders, yeah, that certainly could be a consideration. As a matter of fact, a trader here might look at this and say, the stock has come down, it's starting to rise, a little bit of momentum, this could get up to 220. And so that might be the reason they decide to roll. They may be willing to close out for that 45 cents, realize about 75%, 78% of the original premium that was received, and then sell a new contract out here for the 14th or for the 17th of April or for some other expiration. I'm not going to do that. For this one, I'm going to take the position of the trader who decides, let's just let it work. Let's get that high per day return on the remaining $45. And we're going to take the risk, the trade-off here being maybe a higher risk of assignment as the stock price is approaching that strike. But Scatterbrain, you're welcome. Say thanks a bunch for a good options trading session or training session. You're certainly welcome. I was thinking maybe selling a call on our CAH position down here. We'll do that next week, just in the interest of time. I'll leave that one just as a stock position. But we've accomplished what I wanted to talk about today, and that is the pros and cons of rolling a covered call. There can be arguments for holding, there can be arguments for rolling, and yes, there can be even arguments made for just exiting the stock, closing out the covered call position entirely. But I hope this has been a helpful discussion for you. There's not a right or wrong answer for every trader or for every investor. We just have to weigh the pros and the cons, make the best decision for ourselves if covered calls are playing a role in our portfolio at all. But everybody, thanks for giving me your time today. Barb, thanks for helping out in chat. We are going to reconvene for this discussion next Monday, continue the series, but I also have other webcasts each day of the trading week, unless I'm on vacation, which is actually going to be the case on Friday of this week. But let me make a couple of recommendations to you if you're new to these webcasts. Number one, make sure that you have subscribed to our Trader Talks channel on YouTube. You can subscribe, but just by going down below the video and clicking the subscribe button right now. It only takes a second to do that. It doesn't cost anything to subscribe, but this is where you can join our live streams. You can also check playlists for previous episodes of these webcast series. So for example, if I click on playlists, if I want to see last week's discussion of selling that put on J&J, I could click on playlists and scroll down. The playlist for this webcast series is kind of toward the bottom. There it is, covered calls and short puts. We just click on view full playlist, and you can see the discussion we had last week, building a custom search for short put trade candidates. Another suggestion that Barb and I would strongly make is to follow your favorite Schwab presenters on social media. So you can follow Barb and me on X. You can find Barb there at Barb Armstrong CS. You can find me on X. Just go to @CameronMayCS is my handle there. Just give me a follow. And if you reply to one of my posts, and you can see I've posted over 6,500 times on X, so very active there. If you reply to one of my posts, I just try to reply right back to you. And that allows for interaction when the cameras aren't on. Now, another thing you can do is follow us on LinkedIn. You can find me on LinkedIn. Just go to linkedin.com/in. That's sort of the typical prefix. And then /CameronMayCS will take you right to my profile. You can give me a follow there. And if you reply to one of my posts on LinkedIn, I just reply right back to you there as well. All right. Everybody, thanks for giving me your time. I'm going to let you go enjoy the rest of our webcast for the rest of the day. But I do want to say thank you to everybody that's already clicked the thumbs up. Click that like button. That always helps. So if you enjoy one of our webcasts, make sure you're in the habit of clicking that like button, because it's like applause to your presenter. That's fabulous. But it also gives my video a nice little boost in the YouTube algorithm so more people can find these discussions, like the pros and the cons of rolling covered calls. So thanks for doing that. Barb, I don't believe there was a, nope, no survey, but if you see a survey, if you always fill that out, that's always appreciated. But everybody, go have a great day. I will look for in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.